Hello and welcome to today's conversation. We are delighted to have with us Mr. B. Prasanna, Executive Director and Head of Corporate Finance and Institutional Equities at ICICI Securities. Mr. Prasanna has had a distinguished career with ICICI Group since 1993. Prior to his current role, he headed global markets, sales, trading and research at ICICI Bank Limited. Over the years, he also contributed to various committees formed by RBI, SEBI and FIMMDA, including COBOSAC, set up by SEBI for the development of corporate bond market. Thank you, sir, for joining us today. Let's dive straight into our discussion. To begin with, where do you think we are in the global economic cycle? Is the US Federal Reserve expected to cut rates? And consequently, how is the global asset market likely to behave?
Thank you, Vishu, and pleasure to be here on the show. And thanks for inviting me for this lovely interaction. Yes, I think we are at a very interesting point in the global economic cycle. Fed has been on pause from an interest rate perspective for the last nearly 1 year or so, and finally they cut rates for the first time in the previous policy. And more interestingly, I think they have clearly indicated that the dot plot clearly indicates that there are more rate cuts which is going to come. Now, I think the way to look at it is Fed has a dual mandate of unemployment as well as inflation. And so far, in the last 1 year, they have been focusing on controlling inflation part. And they were a lot more confident on the fact that unemployment is not really increasing in a big way. But in the recent policy, I think there has been a clear shift or a pivot, if I have to call it, that they shifted from controlling inflation to, supporting jobs and supporting growth. So I think from that perspective, we are in an interesting situation. I think the expectations from the Fed are that they'll probably cut two cuts more this year, one cut next year, and one cut in in calendar year 28. But our expectations are that they'll probably do one more cut this year, and they'll probably do 3 cuts next year, so a total of 4 cuts. So to some extent, I would call it as our expectations are for back-ended rate cuts, while I think the Fed expects a little bit more of front-ended. And also the interesting thing is what's going to happen when the Fed chair is replaced when his term gets over, and the kind of new candidate who's going to come in, will he push in for more aggressive rate cuts and all that. So that is where the situation we are in. And from an asset market perspective, I think what's going to happen is the yield curve in the US is going to steepen. And by that, what I'm saying is the short end of the curve is possibly yields are going to fall, while the long ends are not going to fall as much. And that is primarily because of the fact that there can always be questions as to when a Fed cuts rates aggressively, is the independence of the Fed being compromised a little, because we all know that Trump has been really asking for a very aggressive rate cut cycle to start. So that question always comes in. And also the inflation expectations also kinds of, starts getting questioned as from a long-term perspective, does inflation go up? So I think those two things are very interesting to watch out. And the last bit on the asset class is what happens to the dollar. So typically in a rate cutting cycle, since interest rates are falling, it lends itself to less support to the currency, and so dollar will expect it to be weakened as we go forward. But beyond that also, I think a very structural shift is happening in the global markets, and that is that we think that post Liberation Day, for example, in April, the feeling was that global money will flow out of US into European and Japanese assets and all that. But I think interestingly what's happening is US, by virtue of the fantastic growth rates that they are showing, money is still flowing into the US asset classes, especially equities. And but in terms of hedging, I think people are wanting to hedge the exposure that they have taken. So when they continue to buy US assets, they are selling the dollar on a forward basis to hedge their investments, and that is what has led to a lot of weakening in the dollar. We expect this to continue as we go forward.
Right, sir. So shifting focus to India, the environment right now is talking about H-1B restrictions and tariffs from the US. How do you see our macroeconomic position in this? Do you think the triple rate cuts, GST, income tax and interest rates, can actually help in overcoming the Indian economy in the global challenges?
So again, not only is the global markets interestingly poised, but I think even in India, it's a lot of parameters which are moving at the same time. And if you have to explain the Indian situation in just 4 words, I would call them as India is in a cusp where macro is flourishing, but micro is kind of floundering. And the reason I'm saying that is if you look at any of the macro parameters, you can't really find fault with any of them. Look at inflation, it is well under control. It's going to be below 3% on an average basis this year. Even from a 1 year perspective, we don't expect it to cross 4% substantially. From a growth perspective, real GDP growth is one of the fastest, and the Q1 GDP at 7.8% on a real GDP basis was very high than what markets were expecting. And if you look at the external situation, whether it's current account deficit or the BOP situation, everything seems to be broadly under control. There used to be a parameter that anything more than 2% of GDP, if the current account deficit goes beyond that, and then only there are concerns in the global market. So India is well within that at 1 to 1.2% of GDP. So if that is the case, then why really is the micro floundering? And the reason I said that is because maybe we'll talk about it more as we go forward, but it's the earnings growth which is not really coming back in a big way. What really is happening is that we can talk about the valuation concerns and all that at a later stage, but I think a lot of money is actually leaving the country from a foreigner's perspective, and it is a domestic money which is supporting India. And in terms of the economy per se, I would say that it is the nominal GDP growth of 8.8%, which was a concern, even though real GDP growth was at 7.8%, was quite good. Now, the nominal GDP normally lends itself to earnings growth of corporates, and in that situation, when you have a nominal growth of only 7.8%, 8.8%, then you don't have the potential for earnings growth to cross maybe even 12-13%. That's why the earnings growth has been very tepid. Now, to answer your question more specifically on the kind of external headwinds, yes, there are three broad headwinds right now. I think the first one is the fact that you got a high tariff rate at 50%, which nobody expected at the beginning of this year. We all thought that we'll be better than most of the Southeast Asian countries and less than maybe 20%. So first it came at 25 and now it's at 50%. So that will definitely have some implications on exports from India. The second is the fact that H1B visa regulations has undergone a change last weekend, and that also means that there is definitely, from a medium-term perspective, concerns on the remittances that can potentially come into India. And of course, all of this is also the third aspect is the fact that the Hire Act, which is expected to be passed at the end of this year, can also lead to some kind of an outsourcing tax. So even the global in-house centers which are being opened in India, it's quite possible that there can be some kind of an incremental tax rates that the US government will impose on these kind of flows as well. So there is concerns from that side as well. So all in all, I would say that it is the domestic economy which is expected to do well, not yet doing well, but the earnings growth and the nominal growth have to grow much better as we go forward. And in that respect, the triple tax cuts, the income tax cuts, the GST cuts, as well as the interest rate cuts are going to help India in a big way, hopefully.
Right. So speaking of markets, you mentioned valuation concerns. Do you think Indian markets are a bit overvalued right now? Also, a secondary to this, which sectors, in your opinion, are overvalued and undervalued from both economic and market perspective?
Yeah, so that's a good question. And I did mention earlier that the macro is flourishing, but the micro is floundering. And the reason I said that is because earnings growth of Indian corporates have not been coming great, whether it's in FY25 or in Q1 of FY26. And together this period, we are roughly around 5 to 6% on a listed corporate basis, depending upon which index you look at. But the forward PE is close to 21 times. And that gives you a PEG ratio of close to 4, which is quite expensive. But when you look at the US markets, the US itself is giving you a growth of around 12 to 13% on an index basis. And they are also valued at around 20 to 23 times forward. So the PEG ratio is close to 2 or just less than 2 to make US markets much less expensive. So that's the reason why I said that, from a valuation perspective, there are a lot of concerns with respect to the growth potential and the market in India. And also when you look at, comparative forwards across the other emerging markets, whether it is Indonesia or whether it is Thailand. Most of them are between 10 and 15. So India at 20 with a forward of 22 times definitely is on the overvalued territory. All these things were okay when India's earnings growth was at 15% or 13%, because that brings down the PEG ratio to less than 2 or maybe close to 1. But when the earnings growth is only around 5 to 6%, all of these things become a little bit of a concern. So I think from that perspective, I think there are concerns from the markets, and the hope is that as the triple cuts which we spoke about, the GST cut, the income tax cut, and the interest rate cuts, as it feeds into the economy and consumption picks up, as we are seeing around us, very good data coming in from autos and other stuff, I think valuation will improve with earnings growth improving as we go forward. And to answer your question on sectors that we are overweight on and underweight on, I think from a very macro perspective, the call to take is since the headwinds are primarily on the external side, we feel that anything which has a lot of external reliance, like things like IT, pharma, are ones which are having a little bit of an underweight in our stance. And since all the policies that have been taken by Indian government and the RBI are focusing on domestic consumption as well as, the BFSI sector and all that, so we feel that there is those are the areas which will outperform and hence are underweight or overweight. So our overweight sectors will broadly be around BFSI, discretionary consumption like autos, infrastructure, energy, utilities, and so on and so forth.
Right. So let's talk about foreign fund flows. How have FPI been reacting to these valuation concerns? Are they shifting from the secondary to primary market somewhere?
So that's right, Vishu. I think when you look at foreign investors, we can't really paint all of them at one brush. I think there are people who have invested all between 20 and 24. They have made a whole lot of money in terms of returns, and they are very happily booking profits, either by way of an offer for sale in IPOs or by way of, block deals in the secondary market, or just plain and simple selling in the secondary market. So I think these are the kind of FIIs which are actually selling. And at the same time, we are seeing a lot of investors who are even investing with new stories and new ideas. And these are investors who are getting into IPOs, getting into anchor investment, and rotating into new issues. So basically, I think it is money which is getting booked, profit is getting booked in old deals and money is flowing into new deals. But unfortunately for us, the run rate at which the profit is getting booked on the old deals is much higher than the amount of money that is chasing new deals, because you need to find new ideas and new companies as well which are raising cash. So to that extent, I think at the overall net basis, we are seeing two things happening. One is there is an FII sell number which is happening almost daily in the secondary market. And the second is on an FDI perspective also. While we are seeing gross FDI, which is actually not coming down, which is actually going up or maybe plateaued, the net FDI has come down close to zero because of the fact that there are a lot of these financial market investors who have actually taken money out of the table by actually booking profits and taking money out. So I think these are the reasons what is happening on the FPI market. And to give a just very overall fund flow situation, I think or rather the return situation, I think clearly they are finding US to be much more attractive. This year, if you really look at how the flows into equities are planned out globally, US equities have attracted more than $300 billion, close to $300 billion. There are countries like Taiwan, a reasonably small country, but they have attracted $8 billion of investment. China has attracted $27 billion. But India, unfortunately, because of the reasons that I spoke about, we have seen a huge negative of close to $15 billion on a net basis. And this is money which is they have sold and taken money out of the country.
Right, sir. And what about the domestic front? How have the Indian funds been reacting to this FPI selling? Have they been holding on, or do you see a slowdown there as well?
So I think the whole silver lining in our market in this entire scheme of things is the fact that domestic DIIs have been big time buyers. And since I gave a $15 billion sell number in dollar terms, if I have to look at the amount of buying that has happened in dollar terms, I think in calendar year 25, nearly 60 to 65 billion dollars of buying has come in from domestic investors. This includes mutual funds, insurance companies, domestic retail, and so on and so forth. And out of the 65 billion dollars, nearly, I would say, 42 billion dollars of money has actually flown into mutual funds. And this is nothing but Indian retail investing into mutual funds. So I think something that has changed from a structural perspective post 2020 is that India, which was very heavily weighed in Indian household savings, which was very heavily weighed in favor of debt and real estate as an asset class, I think has now shifted predominantly into equities, in the sense that more and more of incremental money is flowing into equities. And even as we speak, there is a long way to go for an overall weightage of assets to change from debt and real estate to equity. So there's a long runway ahead when you look at it. The fact of the matter is that I think household savings are attracting this equity inflows, and the demographic effect, which has been spoken of from so positive way for demand, is also playing its mind in the terms of kind of flows that households are putting into Indian equity markets, and that through mutual funds and through direct, and that will help us at the long. Counterfactually, I can say that had this kind of a DII inflow not happened, we would have seen maybe equity markets tanking by 20-25%. And the fact that we are still holding on to 24,500 to 25,500 kind of levels on the Nifty index means that I think the household savings have really helped Indian markets a lot.
Right, sir. Finally, let's end with the policy. What are your expectations from RBI and the government going forward? Do you think there'll be more rate cuts? Also, what is your view on the key Indian asset classes, bonds, gold, and equities?
So I think from a Reserve Bank perspective, or from a policymaker's perspective, I think clearly they are now, if you just listen to the Prime Minister's speech, or the way they are actually goading people to consume, clearly there is number one a shift which is happening from pushing capital expenditure to consumption. So that is very clear. And the hope is that as consumption keeps increasing, the private sector corporates will also start investing, and hence capital expenditure, capex will improve as we go forward. The second thing is that the government has clearly done, like I said, two cuts. One was the income tax cut at the beginning of the year, and now the GST cut. And between the two of them, it is going to give an impetus to grow to the extent of nearly 250,000 crores. So I think there is definitely something positive. And I think the government is not just looking at GST cut as just a rate cut, but it is looking at it from the perspective of a policy which actually helps in ease of doing business as well. So you can assume that more and more such policy measures and reform measures can come as we go forward. Talking about Reserve Bank of India, I think RBI has also done its bit predominantly by cutting interest rates by as much as 100 basis points in a very short period of time at the beginning of this year. That has led to lending rates and deposit rates falling substantially. That has led to a lot of help for especially the mid and small sectors able to borrow at much cheaper rates than what they were borrowing earlier. And it has also led to individuals able to borrow at cheaper rates in order to fund their consumption, in order to fund their discretionary consumption, as well as fund their real estate purchases. So I think all in all, the policy framework is very, very favorable. What I expect going forward is for the government to also push through more reforms. And for the RBI, I think the call is a little bit more very delicate. While we do feel that a space for a 25 basis point rate cut has opened up between this policy and the next policy, it's pretty much anybody's call as to whether they will actually use that space in this policy itself, or whether they will want to wait and see the implications of a lot of things before they actually engineer that rate cut. But having said that, the fact that our nominal growth is growing only at 8.8%, the fact that we need even FX inflows are not coming in, a lot of FX outflows are happening, which means it's only growth which can drive FX inflows. So from that perspective also we need RBI to support growth, and the fact that the Fed has also commenced its rate cut cycle, giving us some space to cut rates, means that there is definitely going to be a benign interest rate environment for the next 3 to 6 months, or maybe even longer. Whether it will actually result in a rate cut as early as in October is something that we'll have to wait and see. But between October and December, I'm pretty sure that there will be a rate cut from the Reserve Bank. In terms of asset view on Indian asset classes, like I said, I think equities just needs equity. I think the floor for equity has been found by incessant buying by domestic investors. It might not fall too much, though I don't see it going up immediately as well. I think what is needed there is for earnings growth to start going, and our house call is for earnings to start improving from quarter 4 of this year, as quarter 3 and quarter 4 of this year, as well as next financial year. We are going to see much higher earnings growth. So once the earnings growth starts coming in, we do hope that market will start picking up. On the bonds and the gold, I think Indian bonds are pretty much fairly priced. You can argue that the curve is a little steep here. The 10-year bond yields is much on the higher side, with the repo rate being as low as 5.5. You're seeing 10-year bond yield at 6.5. But predominantly, if RBI comes out with a statement which is very dovish in the policy, then you can see bond yields falling by maybe 20-25 basis points maximum. But I think you should be there in the 6.25 to 6.5 range. But it's not as if the rates are going to go up too much as well. And when you look at gold, I think a lot of things are happening internationally. When you look at gold from an INR perspective, the rupee depreciation itself feeds positively into the gold price in INR terms, so that is a positive. Beyond that, the dollar price of gold itself, there is a huge momentum which has taken it up so much. And we do feel that while the rally has been too fast, too soon, if you look at the fundamental factors which are driving gold, all the fundamental factors still exist, and we do feel that it can potentially, carry on in terms of some more time. This is predominantly the move towards de-dollarization which is happening, and the move of central banks more and more buying gold in the reserves rather than US treasuries is something that is also contributing positively to gold. So I think over a next 6 months to 12 months, we see positive impetus for gold as well. And the interest rate reduction which is happening in the US will also help gold in its behavior in terms of price appreciation.
Thank you so much, sir. That was definitely a very insightful session. And to our viewers, if you have any questions, please put them down in the comments. We'll try our best to cover them in our next session. Thank you for watching.
Thank you.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.